Okay, so a quick introduction and practice problem on banking T accounts and expansion of the money supply through the banking system. We start with part A. Spalding Bank has $300,000 in deposits and $30,000 in reserves. All other money is loaned out. What does this look like on a T account? Well, deposits are a liability. They're a liability because they are owed back to depositors. So anybody can come and get that money out of the bank at any time, and the bank owes that back to their depositors. The 30,000 reserves, however, because the reserves, remember, are the cash that this bank is holding at any given time. And if we assume that all other money is loaned out and we know that our T account has to be in balance, we're missing about $270,000 over here. So we can drop in here and say that this bank must be holding $270,000 in loans. And that helps us to complete part A, setting up the T account in the first place. Part B, if the required reserve ratio is 10% for this bank, calculate how much Spalding Bank is holding in excess reserves. So a reserve ratio in general is reserves divided by deposits. For Spalding Bank, that would be 30,000 divided by their 300,000, which is 10%. Take out those zeros. 3 over 30 is 10%. So if they are required to hold 10% and they have 10%, we can say that that means they have 0 in excess at this time. In other words, they are loaning out every dollar that they have available to loan in this moment. In part C, Michael comes along and he moves $10,000 from under his bed to an account at Spalding Bank. Draw a new T account, dividing reserves into required and excess. I'm not going to draw a new T account here, but what we can do is use a different color to show the effect. And really, I think this is the most effective way to manipulate our T accounts. So if Michael deposits his money at Spalding Bank, we can come over here and we can say that Spalding Bank has just added $10,000 in a deposit from Michael, which means that they are now holding $310,000 in this bank. Similarly, what we can say is that their reserves have gone up to 40,000 because all of that plus 10 shows up as a plus 10 on the reserve side as well. So Spalding Bank now has $40,000 in reserves. And there's now really two ways to help us sort this reserve into required and excess. The first is that we know they have a 10% reserve requirement times the 10,000 deposit from Michael means that they must reserve $1,000. And that means that the excess of his deposit must be $9,000. The other way is we can do 10% of the 310,000 the bank is now holding, which tells us that they must reserve $31,000. And if they have 40,000, then that means that their excess again still must be $9,000. In both cases, we're able to see that this is 31,000 of total reserves required plus 9,000 of excess reserves. And our final question here is that if we assume that Spalding Bank and all other banks hold strictly to the required reserve ratio, how much will the money supply increase because of Michael's deposit? So we use our equation that says the change in the money supply is equal to the change in excess reserves times the money multiplier. Our money multiplier is 1 over 10%. So in this case, 1 over 0.1, which is going to be 10. And we get that a change in excess, 9,000 extra dollars to loan out, times a money multiplier of 10, means that the money supply can increase by a potential of up to $90,000. This is our first introduction and a basic process of what we need to do with T accounts. First, you have to be able to actually create your T account. We've got to be able to analyze the reserve, or really the asset side of a T account, to see what a bank is doing. We've got to be able to work with new deposits and how those deposits get put into our assets. And ultimately, remember that those assets are used, or the excess assets are used to expand the money supply through the money multiplier mechanism.